the Federal Reserve, the Central Bank of the United States, hinted at the rate hike in March in a statement after the regular meeting of the Federal Open Market Committee on January 26th. Regarding the reduction of the balance sheet, it did not mention as a specific time period, but disclosed the principle of reducing it in a predictable manner. The Fed has decided to keep the key interest rate unchanged at the current level. However, it also clearly signaled that it would raise interest rates in a near future. Although he did not mention a specific time point, an increase is likely at the FOMC in March when the tapering ends. In this case, it will be the first rise in the rate of interest after December 2018. The statement did not contain any hint as to the extent of the rate hikes. Markets believe that the Fed, suffering from inflation, may come up with a surprise cut that raises 0.5 percentage points at the time. At this meeting, the first FOMC of the year, the dot plot was not presented. Previously, the dot chart released in December last year contained the forecast for average of 3 hikes in 2022. Experts predict that Powell does not rule out the possibility of raising interest rates at the 6 meetings since March, including March, May, June, July, September, November, and December. The possibility of a 7-time hike is higher than that of a 4-time hike, which has been a trend so far. The only way the Fed can fight inflation is through 1-stage tapering and 2-stage rate hikes. The third stage is quantitative austerity. In order to revive the economy, the Fed has been releasing money in a market by buying various bonds such as government bonds and MBS. The Fed balance sheet, which stood at $4.1 trillion in January 2020 before COVID-19, has now grown to $8.76 trillion thanks to the quantitative easing. The Fed is now gradually reducing the size of each bond purchases. This is what tapering is all about. In this chart, reducing the amount of money released in the market and the money continues to be released. Quantitative tightening was implemented in 2017 and 2019. It took about 6 years from tapering in 2013 to raising interest rates and ending with quantitative tightening. And this quantitative tightening was achieved by withdrawing funds in the amount of $100 each quarter when the maturity of the bonds came. He did not use an aggressive method of absorbing liquidity by selling bonds. If the Fed sells bonds, most of them become long-term bonds. This will increase long-term treasury yields. When the amount of bonds is released in the market, the price falls due to the supply and demand, and the interest rate rises. The interest rate on long-term government bonds is closely related to the interest rate on real estate loans. This can increase the interest burden on people who purchase houses with debt, which can have side effects in a chain. The U.S. hastening austerity than ever before is also intended to contain China. China is now growing to bail out because of concerns about an economic slowdown. In this situation, if the dollar strengthens, China will have no choice but to think about capital withdrawal. As the situation worsens, Chinese authorities are lowering interest rates in the opposite direction to the global rate hikes process. This is an unavoidable measure to prevent economic slowdown and credit risk.